Thanks everyone for joining us for our next Ripple Ventures Tank Talk with Villi Iltchev, partner at Two Sigma Ventures, on discussing investing in emerging markets at the early stage. Thanks so much for joining us, Villi.
Thanks for having me.
A quick background on Villi for everyone out there. Villi started at Salesforce as a VP of Corporate Development and at Salesforce Ventures for 4 years, where he invested in over 30 startups, including Box, MuleSoft, Hubspot, Gusto, Zapier, Anaplan, and Adaptive Insights. After that, he moved over to LifeLock, where he was an executive vice president and chief strategy officer for a year. After that, he moved over to Box, where he was a senior vice president of strategy and corporate development for 2 years. Finally, Villi moved over to the venture side, where he joined August Capital as a general partner for 3 years. And now he is currently a partner at Two Sigma Ventures. Thanks again for joining us, Villi. Let's kick things off with your investor journey. I would love if you can tell us a little bit about your journey in starting on the corporate development and strategy side of large tech firms like Salesforce and Box, and the lessons you learned about investing in and building companies.
You know, a lot of my career has been just an accident. It wasn't deliberate. I never planned the next thing very well. And actually, the fact that I became a VC was frankly an accident. I started my career after business school doing investment banking, and I did that for a few years. And even the reason I was an investment banker is nobody else wanted to hire me for anything else. I was a foreign national in the US, so the investment banks were the only employers. And so I ended up in banking because that was the only thing I can do. And after 4 years, you know, I kind of got burned out. It's mostly a sales job. My two best clients, and one was HP, one was Salesforce. And Salesforce said, we're a tiny company, you're going to be bored out of your mind. And HP said, would love to have you. And so I joined HP. That was my first kind of corporate job out of banking. That was in 2008, right before the financial crisis hit. And again, corporate development, that was kind of the only thing people wanted to hire me for. So I ended up doing that for a while. About 12 months or 15 months later, Salesforce called me back and said, we're changing our mind and we want to be much more active and more ambitious and start throwing our weight around the ecosystem and maybe figuring out where the opportunities are around us, do some investing, be more active on the acquisition side, and we need somebody to help us put that together. So I joined Salesforce in 2009. That was still very early. The company was public at the time, but it was still a relatively small company. And it turns out that was probably one of the best things I ever did career-wise, because it was the right place, the right time, the right company, the right founder, and it all kind of came together. Salesforce was very successful, very ambitious, very dominant. And because at the time, Salesforce was probably 2 or 3 times the size of the entire cloud ecosystem together. It was just such a big player. It had unusual importance in that ecosystem and access, which allowed me to then invest in all these great companies, not because I was smart or anything like that, but rather we just had incredible access. No other company, even Google and Facebook today, if they try to do what Salesforce did, they just can't, because in their ecosystem, they just don't have the same influence, prestige, access, etc. And so that was my first experience in investing. It allowed me to build my network, build the relationships, learn the industry, learn the space, learn business models, etc. And I did that for 4 years. We also acquired a bunch of really cool companies, many Canadian too. At the time, we're almost certainly the largest investor in Canadian tech, because we acquired a bunch of Canadian companies. We invested in a bunch of Canadian companies. And then the rest of it just followed. I joined LifeLock. I was one of the execs there. I then went back to enterprise software and did that a few years in Box. And getting into venture was an accident. Some people thought I would make a good VC and said, hey, why don't you join us? And right. I joined August Capital in 2016.
So you were really at the forefront of building out that cloud ecosystem for Salesforce and all the other B2B SaaS companies that kind of came along with it at the early days in 2009 and 10. Were there any sort of things that you were looking for, or was anyone interested in cloud was a good target for Salesforce to back at the time? Like, how did you guys find your way?
Salesforce was religious about cloud. And we had the point of view that literally every part of the stack, at least at the application layer, will get replaced, over the next 10 to 15 years with new applications to replace the legacy stuff. And so it wasn't that hard. In fact, if you were a VC between like 2005 and 2012, I don't know how you didn't make money. A lot of people didn't, but you could literally pick, every category of applications, and you just know there's going to be a Box, a Workday, a Gusto, like in every segment of the market, the opportunity was to build a big company and replace the incumbent. And that's kind of really what happened. We basically looked around us and said, in every piece of the application layer, in every industry, there's going to be a new leader in the next 10 to 15 years. Who are the top 3 candidates? And we would invest in them. And there were emerging areas. So think about areas like customer success. Customer success didn't exist 10 years ago. It just became a thing because in the world of SaaS, it turns out like the burden of adoption of the software and getting value out of it shifted from the customer to the vendor. Previously, you buy a piece of software and it was on you to customize it, to deploy it, to do all the enablement so that you can get value out of it. And then with SaaS, the vendor now has to do that, or you just churn. You just go to somebody else. So that became a new category, and we saw it very early that this is a new category. So we were trying to figure out how to play it, and we invested in Gainsight, for example, which ended up becoming the leader. But it wasn't that hard at the time. Just like it's not that hard now. How the next 10, 15 years plays out, which is all these current SaaS leaders will get displaced by the same version of the software, except it's just going to be more intelligent. It's going to make you better at your job, right? A lot of it becomes a question of access. And so what made me very successful at Salesforce is I just had better access. And so I think that was the story.
That's incredible. I mean, it sounds like that early access is what got you on thinking about the emerging markets and emerging trends with Salesforce. And it's almost like they created their own incubator for testing out a bunch of these areas of the app layer and the cloud before they ended up having to really double down on it. And you were at the forefront of that. So I want to save some of the emerging market talk for later in the presentation, but that's a good segue into the transition to the venture investor role. So you joined August Capital, where you were general partner for almost 3 years. What was the biggest adjustment for you moving from corporate VC to traditional venture investing?
I think the bar is just much higher. So when I was at Salesforce, I was doing about 2 investments a month. It wasn't just me. I mean, I had a team, but we were doing about 2 investments a month, which would make us more active than the top 4 venture firms combined. But there was a different lens on it. It wasn't just about making money. It was about access, visibility, learning, support of the ecosystem. We had many lenses on how we justify an investment, and we had infinite appetite for access and visibility and learning. As VC, you have 2 opportunities to invest a year, and in your career you'll probably do 20 to 30 investments unless you're a seed investor. But at the A and B, you make 20 to 30 investments in your career. And so just the bar is just so much higher. There's so much more pressure. You don't win them all. And so how do you construct a winning track record and a brand and a reputation becomes so critical as a VC in your success. And so I found it really stressful early on because the bar was so high and the risk so high too in your career. No matter how brilliant you are, if you blow up on your first 2 or 3 deals, nobody's going to care that you're brilliant. Mm-hmm. Right? And so I think that was the biggest change for me, is just being very picky about the things I wanted to get involved with. and how do you build the sufficient conviction to act on something?
Yeah, and that sniper rifle approach to investing at a venture level is really important because you are judged on your numbers and your outcomes. Where at the corporate level, there's so many more tangible benefits you can derive from an investment that maybe justify maybe a mild outcome for a company because you got more talent or R&D exposure out of the investment. So that makes it a lot of sense. But you did have one notable investment among others that I'd love to talk about while you were at August Capital, which was your investment in Gitlab when you led the Series B investment in 2016 for 20 million. And the company has gone on to raise over 430 million. Can you tell us about your original thesis behind this investment and what lessons you learned along the way?
Sure. I think I had just joined August Capital. So honestly, the advice most people give you in venture is like, just sit around and learn for a few months and don't do much. Funny enough, the advice one of my partners gave me was the opposite, which is your network, your relationships, your thoughts, your ideas are the freshest now. So if you see something exciting, go do a deal. And I took that advice, and I saw GitLab within a month of joining the firm. And I was actually quite cautious in approaching it, but it was just kind of pretty obvious to me that there's a big opportunity here. Developer tools were taking off. And the reason developer tools were taking off, remember when Mark Andreessen coined the phrase, software is eating the world. Well, as cliche that phrase was, it is actually very true, because what's happening in industry is that all companies in all industries are starting to differentiate around software. So the example I like to give is, like, even if you're Caterpillar, you build big tractors. In the future, the differentiation is not like the quality of your shovels, engines, tires, whatever, the equipment itself. It is the software and services you can wrap it with. So in this world, all companies became software companies, and thus the market for development tools became 10x. Not only that, but the engineers, the developers, were now a strategic asset. They were promoted from the back office, the geeks that build stuff, to your key differentiator going forward as a company. And in that world, tools became very strategic. And you have GitLab, which is open source, very disruptive business model. You have the incumbent being GitHub, which at the time, and it's still, I think today they're doing a much better job, but they just weren't executing very well. And there was just plenty of space for another player to create a big business. The market is big enough. And anyway, long story short, it was definitely an exciting bet to make, even though I was still fairly new to venture. And I'm very lucky to have made that investment, because it's probably going to change my career as a VC too.
Wow. So you really took that advice of just go after it right when you join the firm, find something that you're excited about and thinks that has a lot of legs to it. And you took that advice and you ran with it. And it obviously looks like it has paid off. Can you tell us like a little bit about what you learned maybe, as the company moved up the ranks over to, later stage financings that you've taken with you into future investments and stuff?
Yeah, I mean, I have learned that I had a lot of beliefs and predispositions that I held dear, that I should question my own kind of assumptions around. One of them was, listen, I came from Salesforce. And so the idea that you can build a remote company I was very skeptical around it. I didn't know the limitations, but, I had to keep an open mind about this. Like, GitLab is a 100% remote company. There is no office. They have 1,300 employees in 60 plus countries. There is no place for people to come together other than virtually like this. And so making that bet was a big leap for me. And just, I had the good fortune of being exposed to remote work through GitLab before it became a thing, but I had to get comfortable with that. Another deep belief I held was that the future is cloud only. And I remember talking to the founder and telling him, I can't believe the first bet is going to be in a company that is not a cloud only or even cloud first company. I can't believe I'm betting against the cloud. His response actually was, actually, you're not betting against the cloud. You're betting against multi-tenancy, which is another religion I held because I was a Salesforce guy. Like multi-tenancy was the religion that we held so dear, and that's having to change. And I think that's another assumption I've had to like rethink, what does the future of software look like? Is it multi-tenant? Is it single tenant? Is it on-prem? Is it dedicated cloud instances, which is not a way of saying single tenant application? But that's another thing I learned. I learned about business models. I learned about open source. I learned about one thing I was taught at Salesforce, again, is the value of a new customer is a lot higher than the value of an existing customer. And I still kind of believe that, and we can talk about more about that. But I really, in terms of new bookings, new business, I always looked at, I wanted more than half of the new business to be new customers.
Right.
That was a sign of health for me. And GitLab changed that because GitLab, nobody buys 1,000 seats of GitLab without having used the product previously. The bottom-up adoption of the company would suggest that your big deals are always coming from existing customers and never from new customers. New customers buy a few seats here and there. And so I've had to completely rethink about, how do I think about growth and bookings and like, how should this thing work? How should we incentivize salespeople and compensation structures, et cetera, to build this company? So lots of learnings. It's a very different company.
Wow, that sounds like the land and expand strategy grew on you over time through your investment in GitLab, which is amazing to hear.
And I've always believed that, but this is an extreme case where in any given quarter, new business is probably 10% of your bookings and 90% is existing customers, which it felt off to me early on.
Yeah, it's like if you tell a company, if you can find a little crack or a wedge in the door, kick that door wide open and you'll see how much more of an opportunity there is there. That's amazing. Well, that's an amazing segue into our next topic of where you're at now with Two Sigma Ventures after raising your current $288 million fund, complementing the $60 billion hedge fund parent. Two Sigma has access to over 1,700 data scientists, engineers, and industry experts to support development inside its portfolio investments. So what excited you most about joining the fund as a partner?
Well, I mentioned the commoditization of venture. There were lots of learnings that I acquired over the last 5 years in the venture industry. And I think venture is changing. I think it's commoditizing. I think the days of, 5 looking guys and money are over. They're changing. You have to think about leveraging data. You have to think about building resources and platforms and adding value and differentiating and marketing. We are becoming very much a service provider. The door has opened to the industry. Lots of new players, all adding value in different ways. And so when I was looking for the next opportunity, I really wanted to join a place that has a beginner mindset, was willing to try new things, do things differently, leverage technology, leverage data, and think about ourselves as a startup and how would we disrupt venture capital if we had an opportunity to. And so I thought Two Sigma offered us that type of unfair advantage. On the hedge fund side, on the asset management side of things, they were very much a disruptor to the industry. They started in 2001, around the same time Google was starting, probably with a very similar thesis. Google was thinking, there's lots of data out there. Let's make sense out of it, and we'll build a relevance layer on top of it so we can sell ads. And Two Sigma was thinking, let's make sense out of it so we can build algorithms on top of it so we can trade in public markets. And the company was incredibly successful. And now it's, as you said, a $60 billion asset management firm, but it's first and foremost a technology firm. There are no people making decisions about what we should invest on the public market side or on the hedge fund side. There's data science. They're purely a data science shop. with 300 PhDs and 600 software engineers building algorithms and trying to make sense of the world's information. And then the question is like, well, how can you leverage that to make decisions and disrupt the venture industry? And so we are very much coming from with the same approach to the industry, which is at the early stage, it's less about data to help you make better decisions. It's much more about leveraging data to, more systematic way approaching the industry. Think about workflow and just building processes. And as we grow up over time, we of course are going to focus on, well, how can we actually now build data science and how can we leverage data to help us now make better decisions? We're on that path of a journey. And that's partially what excited me about the opportunity.
Wow. Well, it sounds like the perfect place for an emerging market investor, leveraging all of those data scientists and the inside sort of data that you have to determine what type of patterns you can see. So let's talk about investing in emerging areas at the early stage, which is what you focus on at 2 Sigma. So I'd love to understand how you define emerging technology and if you follow any principles or rules that guide you when assessing emerging markets.
I think the new areas of technology. So there are, established markets where new tools and new applications and new technologies just disrupt the incumbents. And this is a constant evolution in tech. There are vertical solutions where certain markets suddenly become very large that are emerging, but software didn't exist previously in those markets. And now, you have an opportunity to build an application or infrastructure that addresses a new industry previously not served by software. And then new things that kind of come up out of left field that just completely change how we think about software. One of the examples I like to give is like, you look at Dropbox. They built a sync engine that moved a file from desktop to a device and device to a desktop to the cloud. It's just a feature, it's just a tool, right? And so how do you invest in that? And you have to like extrapolate forward, which is like, well, that's interesting. So now you can move files all over the place and you can keep them in sync. And what can you do with that? Does this become a content management company? Does this become a BPM company? Or like, can you build a business around this? And at the time, that was a disruptive thing. Like it didn't exist. We had a way to just upload files into a cloud service providers to view our photos. But the idea of like keeping a bunch of devices and in sync in real time didn't exist. So I think the challenge of investing in emerging markets is really just a challenge of kind of extrapolating forward and using the imagination of what it could be. And that's really difficult. It's really difficult to do. One of the hardest things in venture is just imagining what is possible. If you are too loose with it, you're going to burn a lot of money because you have to be. One of the books I recommended, Authenticity, like being truthful and honest to the core of your belief system and putting your money behind it. You don't want to be a fool, but also that's really the core of the job, is taking risks. And when it comes to startups, one of the things I've learned is the easiest thing to do is to trash startups, to poo-poo on every idea, on every startup, because the deck is absolutely stacked against a startup. 99% of the time, betting against a startup is the right bet. What we get paid to do is to make that 1% bet. And so you have to always think the what if, the how, like what is possible if this actually works. And that is, I think, what is essential to be successful as an early stage investor, and especially in new emerging markets and technologies.
It sounds like a very fine line to walk with the 99 versus 1% outcome, but we all choose to do it as a career path. So maybe we're just crazy. But Would you say emerging technologies could be features and platforms, or they have to be platforms for them to be an emerging technology, and a feature is just an add-on to an emerging technology platform?
I don't know. I think people mean different things or ascribe different meaning to any of these, to both features and platforms. So I don't want to get into defining what we mean when we say these things, but I think it's suffice to say a lot of platforms start as features. Nobody's building a platform. That's not a thing, right? Things become a platform.
Mm-hmm.
But nobody starts out, I'm going to build a platform or whatever. If you're building a platform, you're almost certainly going to fail, and I'm almost certainly not going to invest. Right? Things don't start as platforms. Things become that. And so, what I look for is like real people solving a real problem, having a real vision, a passion for something. Hopefully I see the world through their eyes, and when I do, magic happens and I invest.
Mm-hmm.
But I don't think about I do think in certain markets, developer tools are a good example, actually. I do think that to become a big company, you have to become a platform. You have to become fairly horizontal, at least at this point in time. And so I do think can this be a launch pad for you to expand horizontally and build something that becomes a platform, because tools are transient, right? People get excited about certain technology, they adopt it, and they move on and move on and move on. But to the extent something is a core part of your workflow as a developer, then it's sticky. And so you want to be fairly sticky, and building a platform is the only way to make that happen.
Yeah, I guess you're right. It's not really like everyone sets out to become a platform from day one. It's maybe a handful of features together that end up becoming a platform. So maybe like Box was a bunch of very, unique features. They didn't develop cloud storage from scratch. It was always there, but they built a bunch of features and ended up becoming a platform of their own.
And even Box, think about it. Box can, if it's just a file sync and share platform, a way for you to store your stuff, that is not a platform. It's not sticky. It's not part of your workflow. It is only when you bake it inside your processes, when you start thinking about archiving and data storage and compliance and blah, 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 and you start now thinking about it as a content management system, when it becomes a core part of your infrastructure, that you're going to think very hard before you replace it with something else. Versus whether you use Box or Dropbox for file and sync and share, that's a commodity. That's a tool. It's not a platform. That's how you become a platform.
Gotcha. Well, that makes a lot of sense. So, at Two Sigma, you focus on SaaS, enterprise software, developer tools, and mobile applications. Which of these areas are you most excited / interested in that you have yet to invest in?
No, I haven't done anything in the mobile app space recently. The last investment I made in a mobile app was a company called Hi Hello when I was at August Capital. My philosophy on investing, I think a lot of people say they're thesis driven, and I'm a bit cynical, don't really believe it when they say it. Or maybe we have a different definition of thesis investing. And I have my own thesis. I mentioned already what I think the next 10 years of software look like. And I tend to look for these types of things. Having said that, if I am very specific about the box I'm investing in, I would have never invested in GitLab. I would have never invested in most companies I've invested in, which is not a way of saying I try to encourage myself to keep an open mind, because, my job is not to invent the future. Founders do that, and they're incredibly efficient and good at this. The reason things come in waves, VCs would joke and say, I've seen 5 companies that do this in the last month. That's not a coincidence. That is the efficiency with which founders capitalize on opportunities. That is what that is. So our job is just to keep an open mind and kind of recognize it when we see it. When founders tell us about their dreams, about their vision for the future, I just need to see it. And so while I have my thesis and core set of beliefs, I also am constantly challenging them. And I'm always looking for, new things. This morning, I took a call with a company that I thought there's not a chance in the world I would invest in, but I was still like curious. And it was a storage. Think about hard disk drives, but instead of silicon, using ceramics. I'm like, so I would never invest in that. I'm a software guy, but it's just fascinating. Like, what if this works? And how can ceramics change the storage industry? So I find that you constantly have to keep an open mind and challenge your core set of beliefs and assumptions, because we just never know where it's going to come from.
That pursuit of curiosity on a day-to-day basis is what drives you, it sounds like, with keeping an open mind. And so it doesn't matter if it fits into one of these four categories: developer tools, mobile applications. You want to see it, you want to hear it, and if it's a fit based on the founder's mission and drive, then it could fit into your investment portfolio.
I think the danger of that is the things that sound most exciting to you are things that you know the least about, and the things you're most critical of are things you know the most about. So me investing in ceramics storage, I just don't have any expertise to be investing in that, right? And so probably not a good fit for me, but like finding that sweet spot where your intuition, your expertise is good enough to recognize it, but yet you're broad enough is critical in my mind.
So let's say you find something that has all of those things combined and you're really excited about it. The hardest thing to nail down is timing. So how do you assess timing with regard to making an investment at the early stage? Because as an investor, you're trying to balance the urge to be early when a new emerging market is ripe for investment versus being too early. How do you manage that risk?
Yeah, right. The saying, as a VC, you're always too early, too late. That's really hard. I don't have a formula for it. I don't think it's magic. I do think that at the Series A, my rubric would be slightly different than if I was investing at the seed stage. At the seed stage, I would recognize big opportunities and just try to make as many bets in that space, as long as it's not directly conflicting, as I can. As a Series A investor, I just hold a much higher bar for that, because being too early is a very easy way to lose a lot of money. So obviously you want a great team. Obviously the why now question is so important. Like, what is happening in the market at the macro level that would lead you to make this bet now? Like, in the case of Gitlab, it was a Series B, but it's not like I was the only one that saw it. There are 100 firms that passed on that deal. And so you have to believe that the timing is right. That change of, industry becoming software companies, that shift of the stack and differentiation towards software, now is the right time to build this company. And so you have to look at the macro level, and then you have to believe you're in good hands with a great team. So I pay attention to the team. Also at the Series A, I'm not going to take a flyer on execution. In fact, I actually quite value execution, because it becomes, especially in software, execution becomes more than half of the ball game. More often than not, the best team or application don't necessarily win. The best execution tends to win. And so I want to make sure that the team can block and tackle and execute. And so, you added all these things together and you get comfortable timing, but I don't think there's a magic formula for it.
I totally agree. I think, we're always a bit too early on timing, especially our seed stage investment focus. But a great team of executors can wiggle around through the timing, maze, and, extend runway, pivot the product into a better, segment of the market, enhance the product features that they're working with to make customers aware of it when it may be still too early for them. And so I absolutely agree, especially at our stage. Are there any examples that you were too early in your investments, but you were able to, keep the company going and it ended up becoming the right timing at the end? Maybe it's GitLab or any others?
One company I'm personally an investor in, even before I became a VC, that I invested in was Airtable. I'd known the founder, we were friends, and so I had an opportunity to invest. Frankly, I didn't care what he was going to build. I was going to invest in him regardless. And so, frankly, that's how I invested in Airtable. Though the pitch was quite compelling too, like Force.com done right, which was the most basic way of describing it at the time. Was quite a compelling pitch. But if you look at Airtable, and frankly, you can see a lot of similar companies. Figma is another good example. At the seed, that was not an obvious bet. You're just betting on the founder. At the A, there was no traction. There was like nothing there, just a good product. That was a tough bet. At the B, believe it or not, there was still no traction. Some users here and there, but even at the Series B, it required a ton of product conviction. It required an investor who appreciates good product and can extrapolate forward and believe that this application will eventually mature enough. Think about Figma to take on, a software platform like Adobe that had been building tools for 25 years in the creative space. So, it just took a long time for these things to mature and become the exciting companies that they are today. And so it's a good reminder that it takes a while. Even at the B, it's not obvious that something has clear product market fit and it will be successful. And even at the B, there are opportunities to find a lot of value of companies that are misunderstood.
Right. Well, that's a perfect segue to gauging the traction in emerging markets. And how do you kind of look at early stage companies, given that there are fewer customers and sales at the beginning of a big trend? How do you weigh lower traction against the potential market opportunity?
You have to take a bet on founder and product in this case, right? Like you don't have much traction, you don't have much data to go with. And so the things you're going to go with are product. Do you believe in the product? Back to the Airtable example, Figma. So you have to believe in the product, you have to believe in the founder, and you have to believe in the vision, the future of what this could be. Some things just take time to mature and get the critical mass to where they become exciting companies. So it's a hard thing to do. It's very personal, it's very founder specific, but I think good experienced investors know how to keep their cool and play the long game. Don't get too hot when things are going well. Don't get too cold when things are south. Just keep executing and be there for the founder. And I think that's the best you can do. You just stay core to your beliefs and kind of what you're investing in. Be open-minded to factor new data so that you're not a fool. But if the thesis is the same, the team continues to execute, even though there's no traction yet, nothing has changed. You just stay the course.
It sounds like founder or partner market fit is really important to you. And given your time at Salesforce, where you had that 10, 15-year time horizon for investing, you've developed a lot of patience and sort of empathy towards these founders while they're on their journey, even if the maybe short-term traction isn't there for you. If there's a long-term alignment on the vision and the mission, and you're seeing development in the product and the execution of it before the traction kind of comes with it, you're okay with that, because there's a lot of other things that you can lean on to get them through that sort of startup journey that we all see them go through.
Yeah, I mean, a lot of it is pattern matching again. Like, have you seen this before? Like, a lot of it is what you said, personality. Is the partner the fit? Like, we all have different demeanors and we all have different emotions and handle things differently. It also actually, what matters a lot is where are you in your life and your career? It's not a coincidence that the only people that invest in rockets and satellites are people who have already had very successful careers, right? Like Vinod and David Cohen at Bessemer, yeah, because those are a great way to lose a lot of money, but what exciting opportunities there are. If you're early on in your career, it can destroy your career, but later on, they are completely rational bets. And so, I think our risk tolerance as investors is influenced by, where we are in life personally as a firm. The utility curve, which is an economic theory I definitely believe in, ends up influencing our behavior. And so I think that matters a lot.
That's really interesting. For all the founders listening out there, make sure that the partner you're pitching is at that, sort of later stage of their utility curve where they can take a big risky bet if you have something very ambitious with a 99% chance of failure because they've had a history of successes. They're willing to take those long tail bets on something like yours. So that's a really amazing insight. So, I'd love to hear about how COVID has impacted your team's ability to invest and manage the fund at Two Sigma. I know pre-COVID, there was a trend towards non-traditional markets like Canada and the Midwest. Has that changed for you due to COVID? And if not, are you still pursuing opportunities in those areas?
It hasn't changed at all. We were Zoom centric before COVID. I'm based in San Francisco. The rest of the team is based in New York. Every pitch we do is on Zoom because we were never, or rarely were we together in the same room. And then when people would pitch us, like not always would they be in New York or San Francisco. So we were always on Zoom. This was a very comfortable medium for us. And so when COVID hit, honestly, it had no impact on our workflow and how we worked on our appetite. To the contrary, we actually saw it as an opportunity. And we continued to be extremely active and aggressive throughout the whole time. To my disappointment, I think we only made 2 or 3 investments over the last 4 months. I'd have liked to make more. You and I almost came close to working together on one, which I'm still bummed about that I couldn't get there, but we were very
we'll get there.
We were very active, and not, from my perspective, nothing has changed as far as our ability to build relationships with founders, connect, and assess opportunities. I think it takes a little longer to build the trust in the relationship that is necessary, but it's also more efficient because we can always hop on a video call. So not much has changed.
That's great. It sounds like you guys are well positioned for this. You've got the fund ready to deploy and you want to be actively involved in the market. So we'll make sure that we get everything we can in front of you and your team. I'd like to move on to my favorite part of the talk, which is your book recommendations. And you have 2 very interesting and unique ones here, different from what we see most guests provide on the business startup side. So can you tell us a little bit about your book recommendations?
Yeah, I mean, I'm not a life or business book type of guy. My view on books is there's too many great literature books to be read for me to be wasting time on, the latest business book. And so when I have time, which is a challenge, honestly, I wish I had more time to read. I used to read a lot more than I do now. 2 kids and the job at night, you can do an hour of email or you can do an hour of reading. And I tend to default to working or email, which I'm not sure is the same as working, but separate conversation. And so the 2 I thought would be interesting or relevant to the group is a book that I read when I was young called The Death of Ivan Ilitch, which I think is quite relevant to us as professionals in that the book was written later on in Tolstoy's life when he thought that every other book he had written previously was garbage, phony. He thought of himself as a phony too. And so he wrote this short book where it was about an attorney who was on his deathbed, and he kind of realized that he wasted his whole life on vain, phony things that really don't matter. And so I think it's an opportunity to think about what is truthful about us, what makes us who we are, what makes us authentic, and what's a meaningful, truthful life we can live so that we don't end up like Ivan Ilitch on our deathbed, regretting, wasting our time on stupid shit, whether that is, the image we put for ourselves or the phony cars or the nice cars we drive to pretend to be somebody we're not really, etc. So be truthful, be authentic. And actually, authenticity is a theme. Again, Dostoevsky with the brothers Karamazov, that whole book is about that, is about authenticity. And both of these books are existentialist Bibles. It is the most powerful book I've ever read. And it has a lot to do with, again, how can you live a authentic, truthful, fulfilling life and be yourself.
Yeah, wow. Those are two amazing book recommendations, and I'm sure a lot of life lessons for, investors and founders out there as they go through this startup journey together with people. So finally, before we wrap things up, we always love to ask our guests for any final words of inspiration for our audience.
Find truth and meaning, like do things that matter to you, do things that are meaningful, build meaningful relationships with people, be truthful, be authentic, be yourself. Actually, the books I recommended are kind of the things that had, how I try to live my life, and the books that challenged me when I was young to try to figure out who I am and what kind of person I want to become and be. When it comes to professional life, I think the same holds true. Like, do things that are meaningful, do things that inspire you and are truthful, do it with people you admire, and the money part and everything else will sort itself out. So I guess don't start a company to start a company because that's the thing to do and that gets you invited to the party and blah, blah, blah. Have a meaningful life and do things that matter.
Those are great words and great advice for all the founders out there. Thank you so much for doing this, Villi. Really appreciate your thoughts on investing in emerging areas at the early stage.
Thank you, Matt. This was awesome. I appreciate it.